And welcome to Recovery Report Live. I'm Dan Odess, joined by our very own Matt Sengsourinh on this week's Recovery Report Live right here in the Griffin studio. We have some important information that we want to go over, get a sense of where the market's at. And just remember, we are here, your one source for information you can use. That's what the show is about every single week. We've represented thousands of community associations and business owners and more than $1 billion in recovery, as well as the placement of thousands of insurance policies. We want to make sure that when you need help when it comes to insurance, your property insurance for your business or community association, that you know that we are your resource. So Matt, let's just jump right into the show here. We had our guests waiting a little bit while we mixed it up here on the set to fit us both in the frame to talk about these important issues. I think this is going to be a highlight of the Recovery Report and going over the data information that you have in front of you. I think people need to really realize what is actually going on. I know we just had a major storm. We had Hawaii that had major fires. Our heart and sympathies go out to everyone out there. We're doing what we can to help and assist, obviously, consumers and policyholders at large with claims and recovery, as well as our community. We're always doing it. We're taking donations whenever we can. So if you want a reliable source to donate things to, reach out to us. I'm sure the GlobalPro Cares Foundation would be more than happy to either direct you in the direction of someone that's actually trying to do good, as well as we may even take in those things ourselves and make sure that they get to people in need. So reach out to us, let us know. So Matt, welcome to the show. Let's break it down for them. What is going on right now? What's top of mind? What are you thinking about?
Yeah, absolutely. So I think we can piggyback off of my episode a couple of weeks ago where I started talking about the unfortunate and tragic events in Maui and Lahaina. And I talked about the unbelievable answer from the insurer side that was all over the media, which is that they basically were investigating the cause of loss and the damages when it was a complete fire, a complete loss, in our opinion, very obvious and clear, and that was only a couple weeks ago, and not much has changed, unfortunately. So you and I have gone through, you found a bunch of great articles with some amazing statistics that unfortunately paint a bad picture. We talk a lot about the insurance companies and the carriers, and while we are alleging bad faith and things like that, these numbers actually support some of the things that we see all the time, unfortunately, out there in the world. We'll get into some of the statistics first, but it's really breaking it down into two parts. One is the insurer side, where they complain and lobby for better laws, better advantage, better leverage in various states. And we can talk about Florida a little bit and what's happened over the past 2 years here, especially in the community association world, but also on the homeowner side. And what you see is basically, they use statistics. I think there's a book out there called How to Lie with Statistics. They use statistics to support their point of view, to support their lobbying efforts. But when you dig into those numbers, which they actually have never provided to the state of Florida, which it's been 2.5 years now, they were supposed to do that. Yep. When you actually get into some of those numbers from some of the places that have them, NOAA, this is Maggie Davis from Insurance News, you start to look at a picture that doesn't correlate or is not congruent with what they're talking about. So that's the first part. The second part is, what are those underlying statistics? What is going on? And I think from a consumer complaint perspective and our experiences out there with all the claims, Hurricane Ian, Nicole last year, we just had Hurricane Idalia here in the Big Bend portion of Florida. We can give you live, up-to-the-date experiences, I should say, and correlate some of these statistics to what we're seeing in the field. So let's start with the insurer side. Yep. Just in general, we have a great bunch of charts here. They're going to be below in the YouTube description, bio box, and also on Facebook and LinkedIn as well. I'm going to provide these to everybody just so we're all on the same page. But the two biggest complaints, consumer complaints, are claim delays or payments, right? Claim delays or payments, or coverage issues.
Now, those are the biggest. Those are the top of the list of various different reasons why a consumer would complain. These are the top reasons why.
It's the number one reason for 2023 so far. And I bet you if we get the statistics from the past decade, you're going to see a pattern here. Claim handling, delays, and payment, so coverage or payment, right, is the number one complaint from consumers. So in your 15 years, almost 20 years of experience, Dan, I'm sure this is old news, right? I talk about it all the time. You talk about it all the time. The past year and a half has been very telling, as you know.
No, and we've talked about it on prior episodes where we talked about the OPAGA report 10-06, and and its findings that with representation, you're going to receive hundreds of percentages more than if you do it yourself. And for us, obviously, as insurance coverage experts, been doing this for more than a decade, it's so obvious as to why that would exist. And but the reality though is that sometimes we get caught up as consumers in what we're paying and not what we're paying for. Okay, so we're sensitive to what dollars are going out, but we're not cognizant of really thinking about how the money's going to get paid back to us until you experience a loss and when you're at your worst and when you need the help, right? So taking advantage of that opportunity to profit from the premiums or restrict your access to it. And there's this concept of shrinkflation, which we'll get into in a minute. But and again, mentioned on prior episodes, we talk about this stuff a lot. But here's what I find most interesting and what we want to key in on here is the consumer statistics around these things that are not being talked about.
So let's dig into some of those statistics, and I can actually, you and I can, I'm sure, back into several specific examples of what these folks are talking about.
Start connecting the dots.
That's right. So this is as of the end of June 22nd. So it's kind of the first half of the year. We'll call plus 22 days. But there have been 7,751 closed insurance complaints. Closed insurance complaints. Okay, what that means is there were complaints made against insurers across the country, 7,751 that had a result. They were resolved. Of those 7,751, and again, when we get to the end, we'll correlate it back to what the insurance companies will spin this as. The most prevalent topic or reason was claim handling delays, which was about 24% of those. Okay. The next biggest complaint were actual denials, but they were on the small end, only about 11% of those. Okay, unsatisfactory settlements and offers were another 10%. And overall, when you take a look at that entire scope of data, 2/3 of them were then resolved. They were overturned in favor of the insured.
Yes.
2/3. It's not the other way around.
So that's the punchline.
Right. So bottom line is they complain specifically in Florida and other states where they say it's the litigation, it's fraud, it's all these other things. And then you look at the data and you realize that there are on an aggregate basis, 2/3 of the time or more, it's a little bit over 2/3, they're having to pay these settlements. They're being told that they are wrong, the insurers, and they have to provide coverage and pay for the damages.
So just to summarize in simplest terms, it's the majority of the time the insurance companies get it wrong, they fight it, and in fact these things are resolved in favor of the policyholder.
And then complain that the cost of fighting it and defending themselves is driving premiums.
Is what the cost is, and also this idea of increased frequency of loss and damage, right? Or is that true or wrong?
So
that's interesting, right?
Another interesting topic here. When you look at inflation-adjusted numbers in dollars, right, for total damage and things like that over an annual basis, we can break it down into decades and go all the way back. We have a chart here that goes back to the 80s. So, 80 to 89, 90 to 99, 2000, 2009, 2010, 2019. One of the most active parts. But I think one thing that they forget about is that from 2010 to 2019, there was probably thousands of social media platforms. You guys know all the important ones, right? Facebook, Instagram,
all rolled out.
Twitch, LinkedIn, everything, right? So
stay with us on this. Follow the trends and follow what Matt is saying, because I think it's kind of one of those aha moments.
What's interesting is that for the first time that decade, 2010, 2019, all of a sudden we had all these other catastrophes, all these other natural disasters
being reported on. And I'm going to air quote that.
Right. So when you break it down into dollars, all of a sudden they're taking all this data that wasn't available before, and they're putting it together and claiming that everything is trending in an upward manner. It's trending higher and increasing. But then if you actually go back and break it down on an aggregate basis, it's really not. I mean, in 1980 to 1989.
Well, no, say that again, Matt. Say that again. It's really not.
It's really not. It's really not. So I'll break it down very easily, right? In 1980 to 89, they only had $31 billion disasters. 31 in 19. Think about what $1 billion is worth in 1989. What it's worth today. Think about what I'm saying, right? The cost from 1980 to 1989 for those $31 billion disasters was $205 billion. Okay, on an inflation adjusted basis. 55 for the next decade, 1999, and 67 from 2000 to 2009. All of a sudden, 2010, we had $128 billion disasters out of nowhere. All of a sudden, Okay? The problem is when you do it on an aggregate basis, it's almost the same dollar amount, right?
It normalizes.
Right. It normalizes. There's actually a trend where they want to blame it on all these other things. We won't get into the politics of all that. Maybe that's a side conversation for everybody. But all of a sudden the numbers get so much bigger.
Well, you did have an election season in that cycle as well.
Yeah, so. Of course. There you go. So so now when you take out 5 years and then 3 years, and we look back just from 2022. All we hear from the insurance lobby is that everything's so much more expensive. We have to increase our premiums. They go to the superintendents of the states. They ask them for increases. They tell them there's all these catastrophes going on. There's all these claims they have to pay.
All these public adjusters, these attorneys attacking us, driving up costs, inflating estimates.
Right.
By the way, during that same period of time, if you remember on a prior show I was talking about consumer complaints and where certain political officials were in their careers and what they may have been responsible for during those certain times. And I talked about the consumer complaints within Florida relative to complaints against public adjusters
What's that
during that same time. So there's over 100,000
all
right, during a period of time when certain political officials were managing staff responsible for protecting. I would argue that in that position we'd be protecting the public, right? And to less than 100 against public adjusters.
Right.
And then you have the statistics regarding disputes and being resolved 2/3 of the time in favor of insurance during the same time. And if you normalize the statistics of the amount of loss and damage and the dollar values here, we're not seeing the same scenario and picture that's being painted by the insurance industry.
Right, and again, I want to read part of one of the reasons. They have many reasons why they're basically backing up these claims here, but one of the reasons here that they highlight is part of this, again, could stem from cost-saving measures. Many insurers turning to tools like automation to quickly deny claims with little review. The reason why I bring that up is because we're at 41-year highs in inflation. The trend that is obvious and clear is that people are moving out of the cities and they're moving to the coast, like Florida, down to Texas and Houston, out to California. I mean, you're seeing this migration, and their biggest complaint is that there's more people living in these coastal areas in the United States. The cost of labor, the cost of materials is going through the roof right now. The values of the properties that they're insuring are much, much higher. Of course they're going to be higher when claims come. Of course loss and damage is going to cause a higher number of claims and dollar amounts, of course. But again, that's not adjusted for what the statistics that they're using there. It's not adjusted for that. They're just doing it on a dollar-for-dollar basis. So in aggregate, when you take a look at that stuff, it doesn't make sense. The trend isn't going that way. When you extrapolate the data and you actually look at it on a normalized pattern, you're the engineer, you understand statistics. Yeah. I went to finance school, I understand statistics. It doesn't make any sense. What they're saying doesn't, on paper, the way they write it, the way they describe it, it makes sense. But when you take the data out and you extrapolate and you start looking through it, it doesn't make any sense. And the biggest thing, though, going back to what you said before, at the federal level, I'm pretty sure, and we have another chart that we can share with everybody that says that, again, 75 to 76% of the time, when you look at claims that go to the federal courts on appeal, they get settled before they even get to court.
Resolved, yes.
Think about what I'm saying. 76% of the time, they settle before they even get to court.
Right.
Because
and
they know.
And I think is important about the statistics you talked about, though, is that we're not talking about just resolution. We're talking here about this statistic about resolved in favor of the insured.
Right.
Okay, and I think that's an important part because there was this massive campaign against the trial bar in Florida and various other places as allegedly the proponent of it, despite the fact that certain disclosures regarding internal records and information was withheld, I would argue, and not produced prior to the special sessions that were set, where a lot of this anti-consumer legislation was passed in Florida that, quite frankly, based on what we have read, actually led to a dramatic increase in actual litigation. And also, it is believed that it's not going to dampen it at all when we have the value panger report, which you talked about a bunch of times, how 68% of actual homeowners that experience loss and damage are complaining about things related to the claim payment, the resolution of their claim as it's been adjusted by the insurance company. That's the complaint. Now, so I made a comment earlier about sometimes that we're more concerned about what we're paying for than how it's going to pay you, but it seems as if that as these inflation issues kick in, as our economy gets a little bit strained, as the dollars become more important and they continue to tax us on this, tax us in a way by slamming these huge premiums on us, increases and everything else, and then fight it on the other side of it. It's like, what value are we deriving from this entire process?
So that's a good point. So let's talk about that a little more because you mentioned it earlier. That's a good point. So shrinkflation is something that is very easy to see today. Premiums are going way up. Most associations, I should say, most homeowners are finding that on a 3-year basis, 20, 30, 40, 50, sometimes double. From a premium standpoint. The insurers that we've seen the past 3 years are also doing everything on a sublimit basis, right? So they're throwing more exclusions, more endorsements, more limitations, and then they're also basically saying that less coverage, based on the deductibles, based on the higher premiums, that less coverage is the end result. So what happens there, right? You have less potato chips in the bag. The bag of potato chips costs more, and there's a lot of air in there, which is nothing. You get nothing. There's no value meaning, right? So what's interesting is that again, they're complaining that the trends are supporting all of their woes at the
because of claims
at the insurer level. Meanwhile, it's really inflation at the end of the day. And then their losses, when you look at their balance sheets and you look at their quarterly earnings reports, their losses are on the investment side, of course, because rates are at all-time highs.
Yes.
They've more than doubled now. We're at 2.3 or 2.4% or times, exponentially higher, obviously. And all of a sudden, their investment losses are weighing on them. But they're blaming claims. They're blaming the other side of the balance sheet.
For performance issues.
Right. And so we've had a couple of closures. State Farm, Farmers now. Farmers actually, we just reported they're going to lay off about 11% of their workforce, thousands of people. And what's interesting, again, is, in a year or two, they're going to be right back here. Right? They just want to get rid of this balance sheet. They want to clean it up because they're beholden to their stockholders, right? Their shareholders.
And I mentioned on prior broadcasts, we're talking about it's anti-American, anti-business strategy of supporting insurance companies on the political side, because historically, if you actually look at the numbers, the rate in which they're either hiring or not hiring, again, and they don't produce products.
Right.
Okay, and most of the money that is paid to a lot of these insurance companies, in some way or fashion, finds its way offshore or invested somewhere else, and not coming back in any sort of way as jobs or new industry or products. And there's been a slow adoption of technology on the consumer side, as far as while they're investing money in the underwriting process on the actual claim side to make the process more fair and honest and transparent. There was a lot of InsurTech investment. I mentioned it once before, how you had InsurTech CEOs of now bankrupt companies coming out and said, we had a great idea. The insurance companies simply just did not want to adopt it. Again, these are things to create transparency, to create a faster, more efficient process, et cetera, et cetera. So you're not having the investment in technology that you once had. Now, again, when the reports talks about the investment technology and you drill down and you actually look at where those dollars are and they're reporting on those things, you're going to notice that it's, again, in the underwriting side of things. It's not typically consumer-facing.
That's right.
It's rarely, if ever, consumer-facing. And if it is, look at that technology very closely to see who it's actually advantaging at that point in time, and whether or not it's actually you, the consumer, who's paying more for less, so much more for less, and their profits continue to soar, even in tough times like this. And I'm talking about profits derived from, obviously, premium dollars collected, because, again, they're selling you inferior product for a hell of a lot more money. They're not investing in anything else to make it more transparent for the consumer. Most of the investments we see on the underwriting side of it. The data regarding loss and disaster, there's a lot more extreme stores being reported on, but are they relative to past statistics? Now, insurance was most often typically based on prior, it's like a Markov chain. There's many various other statistical analysis you can do. It's usually it's based on past performance. It's based on past occurrences, et cetera, et cetera. There's actually a look-forward model that they're implementing rather than a look-back model.
Now in Florida, actually, they're allowed to choose 6 different models. They're allowed to choose from 6 different models out of, I don't know, hundreds. There's probably hundreds out there, depending on what state you're in and what university or college you're at, obviously. They're allowed to choose between of those 6 models, and then they can use that forecast to plot out, which the actuaries of these companies will do, to plot out, right, what their returns are going to be. So to be clear, they're not plotting out how much they're going to pay out. They're plotting out the exact opposite. They might mask it and they might disguise that exercise, that practice, by saying, "Oh no, we're plotting out how much we're going to have to pay." No, they're actually plotting out how much they think they can earn in spread, right, on their balance, on the side of the balance sheet. That's all the investment side. It's all LDI. It's all zero coupon bonds, high yield bonds. They're trying to ladder out a return profile over the long term, and they need that over 20, 30, 40, 50 years. They're beholden to their shareholders on a quarterly basis because of that. And then on the other side, right, how do they lose money? Overhead and paying claims. So they're going to look at a model that says we're going to have 25 major storms in the Florida, the Atlantic or the Caribbean or the Gulf of Mexico in the next 5, 10, 15 years. That's going to cause this amount of damage. They're going to forecast that over a labor and material model that they have some kind of I guess like premium on a given base. Like, it's all modeled out. And then they're going to turn around and say, well, if we're going to lose this much money in year 5, 10, and 15, your premium today is going to be this, right? So that's how they're doing. That's literally how they're doing it. It's a business decision. And then unfortunately, though, right, if it doesn't happen, you think they give that money back? You think they reduce premiums later? No. I don't think so, right? It's like taxes. Once they tax, you're not taking it away.
Yeah, no, we haven't seen even something even close to a soft market or a regulatory environment that is pro-consumer in quite some time in all states throughout the United States, as well as abroad. I mean, we're talking in England and various other places.
By the way, exactly. So 2010 and 2019, how many times did you hear in meetings, "Oh, we're in a soft market right now," or "It was a soft market back then, and so you could get paid for that loss and damage back then, but today, no." I mean, that's not what the numbers say. Yeah. So it doesn't make any sense, especially pre-Irma. Like before Irma, I mean, you remember better than I do, obviously, but they always use that as the example. It was a soft market back then. I call BS, but
Well, and if you also I guess a kind of a final point here too is that I remember not too long ago where one of the brokers would make an argument stating that your premiums are comparable to what you paid 7, 8 years ago.
Yeah.
Okay.
Yeah.
Today, so really, if you look at that, you really got the benefit of lower rates for so long, and it's really just marginal or the same as what you paid then.
Right.
But what they weren't disclosing or pointing out is that what you were buying today for that price was so far inferior to what you bought then at that same comparable price. So the idea of shrinkflation here, which is they gutted the policy and you paid a hell of a lot more for it because while, yes, dollar for dollar, the cost of insurance, generally speaking, might have been comparable, the products themselves were nowhere near comparable. They had huge deductibles. You had no mold coverages. You had separate deductibles on different types of losses, like water claims suddenly had $25,000, $50,000. I even know one association right now that has $1 million water deductible. Back in 2017 or before, you never heard of anything more than an all other perils deductible. That was it. $2,500, $5,000, 1 to 3% deductibles, standard across the board. And now you're trying to tell me that, well, you know what? You benefited from savings for a decade, and we're just simply back to where we were. Don't worry about it. Exactly. It's just a budget thing. Let's just move forward from here. And it's like, you're not moving forward. In fact, you're paying for a hell of a lot less coverage at a hell of a much higher premium.
Yeah, that wouldn't make sense if you're paying higher premium and have higher deductibles, right? That
well, now we're there, right? Now we have higher premiums,
exactly.
We have higher deductibles, and you have way less coverage. But when there was an inflection point there, right, where the lines kind of met on price. But the other line that they didn't show was the graph where coverage was dramatically going down due to higher deductibles, less coverages, more exclusions, no endorsements, etc.
So as a curveball, I can also take the rest of this chart here and look at it from that context, right? And I can say that the deaths from 1980 to 1989, way back then, the deaths that year, that decade, were 2,970 deaths, around 300 deaths per year. Okay. Today, I would argue that these buildings are built. They're fortified better. They have metal roofs, a lot of these associations and homes. We've learned from that.
Which you used to get a benefit and a discount for doing.
Exactly.
Now it's just, well, if you don't do it, I'm not even going to insure you.
Right. So today, on an aggregate basis, right, the decade that we've just seen, the death count is a little bit higher, but again, in aggregate, right? So we're talking about today. There's the population, I think, doubled, maybe even more since the 80s. Obviously, we're in a different time.
Are those trend lines following each other, or are they somewhat? Is there a gap created?
But if you look at it just here on the chart and you look at the numbers and one is higher, you're going to say, okay, yeah, it sounds like more. But that doesn't mean that it's actually more, right? And so at the end of the day, the buildings cost
relative to
the
where
loss,
we were,
the loss and damage numbers that we're talking about. The buildings cost way more to build. They cost way more from labor and materials. But we're using better materials. So in the midst of actually trying to fortify these structures better,
we went through a major construction boom.
That's right.
All these more units.
That's
You remember back then when there was a recession? They're like, oh man, there's like 300,000 units in South Florida that are just on the market. They're never going to be filled. It's going to take us 15 years.
That's right.
And I think the statistic was it was like filled within like literally like a year and a half to 2 years, gone, full.
But that's not contemplated here. It's not
the coastal area.
Yeah, there's nothing in here that breaks that down and says incrementally it's not that much more because of this. And again, that's I would assume. Not included on purpose, but that's just
reading through the bullshit.
Yeah, that's just me. But ultimately, to kind of wrap everything up, I mean, really, it's the same story that we always talk about. The environment today, talking about the landscape is what you originally asked about in the beginning of the show. Talking about the landscape today, you're paying more for higher deductibles and less coverage. The consumer complaints are growing, but the trend line that is pretty true that we can go back over decades. Really says that, again, 2/3 of the consumer complaints are actually in favor of the closed, settled, resolved in favor of the insured, which is a great sign for us. I love that's how the scales are leaning, right? And that's how it should be. It's a contract of adhesion. It's a unilateral contract. Is one way. So it's David versus Goliath. We always say. I know it's a little dramatic, but to know that it's in favor of the insured is what we fight for.
And with representation.
That's right.
Hundreds of percentages more. It's proven. That's another statistic that kind of gets buried and brushed under the rug.
That's the final point that I wanted to make to wrap all this up. The only thing left that the insurers have to battle from an obstacle standpoint to getting more leverage is what? What are we seeing in these residential and commercial policies now? We're seeing, basically riders, right, or endorsements that basically say, you can't have representation. Some say actual public adjuster. You cannot have a public adjuster.
Anti-public
adjuster, right? Some
even though you have a legal rights to representation in Florida or many other districts, where the question is that how can you approve a form that allows an insurer to say, hey, we're going to include an endorsement. By the way, I have yet to see an instant where that anti-public adjuster endorsement was added to a policy where the insured or the consumer actually received some sort of discount or benefit from it. So riddle me this. What is the benefit of allowing an insurance company to include a form that prohibits you contractually, not legally, but contractually, from representation? When so much of the statistics point to that with representation, you're going to get more, and the consumer complaints are on the insurer's side and not on the consumer side. Right. It's like, well, what is your complaint about us, and what is the truth of this? Because when I look at in favor of the insured, with representation, you will get more. All these things are going in the direction of the consumer, but the legislator seems to be moving in the direction of the industry in a very anti-consumer, anti-business, anti-American type of sentiment that doesn't make sense. These are not companies that are hiring people. They're not producing products. Most of them aren't even domestic companies. They're foreign entities. Even if they're domesticated, they still have foreign offshore bank accounts and companies and everything else for which they use to move money off the balance sheets. We talked about the managing general agent and the structure which we have, particularly in Florida, and how unique it is. We talked about look-back models versus forward modeling. And again, a lot of this forward modeling, when you break down that stuff, it's not even looking at historical data. It's literally simply whatever it is that's been given to them, produced at that moment in time, they will adjust it to it rather than looking back at some of these important things that Matt has brought up here today.
And to piggyback off what you said in the beginning there, so contractually, yes, it prohibits you from getting representation contractually. Statutorily, I don't think that's true. I think
correct.
I think it's gamesmanship.
I said it's contractually. Yeah. Legally, you have a right to it.
That's right.
Contractually,
but that's important because most people will read that. Most insureds will read that and say, okay, right? Like, okay,
Well,
but that's the effect that they want. It's not even legal, right? But that's the effect that
But
they want.
get to delay the claim.
That's
they're
right.
creating an issue
That's
of
right.
fact, and
That's right.
everything else.
That's right. So that's part of it. The other part of it is how did they lobby for that? What was said to the superintendent of the state of Florida specifically to allow those endorsements? Like, how did they go and make their case for saying, asking for this endorsement? It's crazy to me.
It's an interesting point you bring, because I do know that there's been at times when legislation has been proposed to basically essentially outlaw public adjusting in Florida and other states too. And those bills failed. But somehow the OIR, Office of Insurance Regulation, has actually approved a form which allows an insurance company to basically do the same.
Do the same thing, yeah.
Through contracts.
Yeah.
Even though you have a legal right to it. So and FAPIA and NAPIA and various other trade organizations for public adjusters are contesting this issue and asking for legal opinions and everything else, and we have yet to see the outcomes of that stuff. Probably a little delayed intentionally, I would argue. Sadly, I don't look at this stuff optimistically. I look at it pessimistically oftentimes because, again, it's been just so much negative news and move towards hurting us as consumers, restricting our rights in a way to supposedly protect us. How is this protecting us? Well, if there's laws have been proposed to try to somewhat outlaw public adjusting in certain ways, or disenfranchise public adjusters from practicing or from people getting into the practice of doing it, then why is it that suddenly an insurance company is allowed through contract to basically say, no, you're not allowed it? Again, I don't believe it's going to hold up. I know that citizens at one time tried passing they lobbied for a lot of legislation that was ruled then thereafter unconstitutional regarding solicitation and fees and et cetera, et cetera. So I think the same will be seen here. Time will tell. I think there's a lot to unpack from this episode. Matt, thanks so much for joining me, man. This is
Thank you. A lot.
We threw a lot at you today. There's going to be so much stuff, as Matt mentioned, right down inside the in bio box or inside the descriptions that you will see on our various social media platforms. But you're only going to see it, though, if you're following us, liking us, and subscribe to our YouTube channel. This has been a hell of an episode. Matt, thank you so much for joining me, man.
Thank you, sir. Appreciate it.
We'll bring you more and more of this information. And I think, Matt, it would make sense to maybe break down some of these stuff and actually show you guys in real time while we're doing these broadcasts what we're talking about. But again, like us, follow us on our social media, and you will make sure that you have those links right there. You'll be able to click on these things. Formulate your own opinion about these things. Read through these reports. It's exhausting. It's dense. Matt printed out like 20 pages of it, brought it here. Only looked at about 3 of it, but there is. These reports are hundreds, if not thousands, of pages, and they link to other reports upon other reports upon other reports. Again, we're going to make sure that's available for you. So if you haven't already, like us and follow us, and join us next week, same time, same place, right here on the Recovery Report Live.